All right. Good morning, everybody. FOMC today. It's the thing. It's the only thing on the docket that really matters. You can see we've got a pretty large list of economic events. Quite a lot of them are going to tie into the same time frame. As we usually do. I'm going to start with what happened in the overnight hours, kind of take a look around, get a feel for whatever's going on around the world. How did Asia do? How did they close? What's going on in Europe right now? It's around lunchtime there, right? It's 12:30 in London. We're really looking for anything that stands out that may carry through on the day. Whatever sector was doing good in the overnight hours generally tends to do good in our own market. But today, everything is dependent on the FOMC minutes, right? So we can see that we got Bowman speaking today. I don't normally use this browser, so I'm not signed in on his, but we got Bowman at 2:20, and it seems like he's going to be speaking this morning at 9:30. U.S. business inventories, gasoline inventories. Really, the main thing is the FOMC, right? Those minutes. Now, I was talking to somebody yesterday who seemed completely confused and thought that this was another FOMC meeting where they were going to come out with a rate hike and blah, blah, blah. This is not that, right? All they are doing is looking at the minutes that were already released. Or let's say that was from the meeting that we've already heard about. After the meeting, Powell comes out, chips his teeth, kind of gives us a broad summary of what was discussed. But investors want more clarity than that, and the Fed has been more transparent than that in the last few years. And if you really want to learn more about that, one place that you could go would be to Econo Day. Econo Day is where Thinkorswim gets its information. So when you're on Thinkorswim and you're trying to read this description, it gets the little pop-up box, and you can kind of scroll through. But as soon as you click away, that box falls away, and that makes it hard to keep your place. And just it's a weird way of trying to do anything. But Thinkorswim actually gets its data from here. So when you try to read that, you're reading what this gave it. So a better way to do things would be just to go to the Econo Day website. It's free. You don't have to buy anything. And then if you go to the FOMC minutes for today, it's going to give you a really clear understanding of what's going on. I've always liked the descriptions from the Econo Day because it has this little section say, why do I care? Or why should I care? And I like how it breaks it down between what a bond investor would think about or what a quote regular investor would think about. It's really it's a nice perspective, and it's from this that you could follow up with, say, more research. You could hit Google and kind of go looking for some of the things that they talk about. But it's just the minutes. All right. So this is the minutes from a meeting that has already happened. We already know the rate hike that they had discussed. The thing is, we're trying to glean insight on what they're going to do in September. We, as a market, seem to have been pricing in a 75 basis point rate hike. And then when the CPI numbers came out, you'll notice how the market spiked really, really strong, right? Well, why did it spike? The CPI numbers convinced the marketplace that we weren't going to get a 75 basis point rate cut, that we were more likely going to get a 50-point rate cut. So they started to unwind all those trades that had priced in a 75-point cut. And that's why we got that strong spike like we did, because the market really is under the impression that we're going to get a 75 basis point rate hike, not or a 50 basis point rate hike, not a 75-point rate hike. So with that in mind, if you are on the Fed Watch tool, you can see what our current rate is between 2 point or yeah, I'll put the decimal in between 2.25 and 2.25, right? We kind of split the mid there. That's kind of where we're at. What the market is trying to price in is, where are we going to be in September? Are they going to raise it 50 basis points, which would put us between 25 and 75, right? That'd be 50 points. Or are they going to hit us with 75 points, which is where we go from 225 to 3? Now, notice in the last, well, you wouldn't notice because you haven't been looking at this, but if you had been looking at it, 50 basis points was in the lead. There was a 60% chance that we were going to get a 50 basis point rate hike in September. In the last 2 days, this has now started to flip over. And I'd say really since yesterday, because that's when things honestly started to change. So between yesterday and this morning, it now went from a 60 to a 40 and from a 40 to a 54. So this is where we get an idea of what the market is trying to do. Are they pricing in 50 basis points, 75 basis points? Where are we at now? What's our target and what's the likely target going to be? The minutes that are going to come out today are going to help the marketplace try to figure this out. It's going to help the market determine what the Fed is more likely to do, hit us with the 50 or hit us with the 75, right? And notice it's only a 50 and a 75. There's no argument here about, oh, well, maybe it's going to be a full 100 basis points. Now, if you go to September, that's where they're pricing in more than one, right? It could be 50, it could be 75, it could be a full 1 point basis. You go to March all the way out to next year, now you can see that there's a lot of different ones that it could be, right? They're saying by mid-March, we're likely to be sitting at a target rate somewhere between 3.75 and 4, and that's the greatest likelihood by the time we get to March. Well, those numbers are what you see moving the market. When we get like CPI data and things like that, the market looks at that new information and says, well, because of the CPI we just got, we believe the Fed is going to do X or Y, whatever it is. So these minutes that are going to come out today are going to help people really kind of discern what they think the Fed is going to do in September. And that's what it's all about right now, is what's the Fed going to do in September? Are they going to hit us with a 50 or are they going to hit us with a 75? Right now, that's the only thing on the docket. I'm going to post this into the chat so that you guys can go there on your own and kind of check it out. Right now, a 50 basis point rate hike is priced in. The market priced that in after we got the FOMC, right? They had been pricing in a September 75 basis point rate hike, but when we got the CPI data, the CPI data kind of implied that we weren't going to get a 75, that we were going to get a 50 basis point rate hike, and that's why the market exploded higher on the CPI report, right? So I'm getting some feedback from YouTube that says they can't hear me. Man, that restream is getting to be really annoying. It's just really frustrating. Let's see what I can do. All right, so thank you, Chemo. Apparently, it's just you, Lamont. You're the only one that can't hear. Appreciate the feedback, guys. That saved me from pushing a bunch of buttons and maybe screwing something up. All right, so this is just a Fed fund tool. It's a useful tool. It's kind of a little wonky if you've never really messed it before, but they do have education on how to use it. They've got a demo video, a user's guide. So, you know, everything that is new, maybe you've never really used before, might seem kind of weird. Like, oh man, I don't know. This seems confusing. It's really not. Take a little bit of time. There's some YouTube videos on it. I haven't made one, but there's a lot of info on how to use. It's called the FedWatch tool. It's very simple. It's a very easy thing to use. So right now, it's all going to come down to the FOMC minutes today. That these minutes are going to really, hopefully, shine a light on where they believe the Fed is going to be for September, and then we'll see the market continue to stay on this path of a 75 basis points, or they're going to start pricing in that 75 again. And the other day it was 60-40. It was a 60% chance that we were going to get a 50 basis point rate hike. Now that number is turned around and we're seeing the effects of that. I really thought we were going to bounce on that low of yesterday this morning. We didn't. I got ran over, but that's okay. That's what stops are for. That was a good play. Um, I had already started to move my stop up when we started to bounce a little bit, so I didn't take much of a loss, but it was worth a shot. That was a At least I didn't sit around waiting on it. I had a lot of work to do this morning. So we did not bounce there. We did hit that 200 period moving average yesterday, and the market immediately sold off afterwards. Like we watched and watched and ran it and watched and ran it until it got there, and it got there. And there was some news that came out on crypto right at the same time, and whoa, the market just sold off hard and fast, and it was awesome because after running it all the way up there, we got out a little early, right? Because I kind of figured everybody was going to front run that 200. So I got out just a little early so that I wouldn't be the last one holding the bag. Caught it on the flip and ran it down. And it was like a train on rails. It knew where it wanted to go. It was a beautiful trade. I hope you guys caught that thing yesterday. Those are the kind of trades, those are the kind of opportunities you want to focus on, right? You're not going to get something like that every day, but when you can see one lining up, take the time to prep it out and get ready for it. Just like that bounce off of the lows yesterday. Now, I wasn't in the office um, on that bounce, but it was very, very close to the Globex Open from back here, institutional pivot point. So just really awesome. I did get a write up though. Boom, boom, boom. Right there. So when we were um, basing along those lows, we had a TRB setting up, which would send the market back to the RTH open and then to the RTH high and then a breakout from there. So lined it all out. I wasn't in the office for that low, so I didn't even get that opportunity, but lined it all out, drew the breakout, put the green line into play, and sure enough, beautiful follow through between the higher highs and the ticks, the cumulative tick coming in with conviction, the sectors rolling over. There's the follow through. We ran right up to the open, crossed right through it, broke new high a day, went through the close of the previous day. And the target was, well, let's just aim for the high of the previous day. And then we'll line out the other targets all the way up, right? All the way up. And at the same time, we had crude helping out. The dollar was helping out. You know, the NQ had gotten through the Globex high and was struggling there. The VIX was continuing to sell off. Like it was just a great day yesterday. Textbook, everything was falling into place. The market did exactly what it was supposed to do. And now we're lined up, ready to go. We just need these FOMC minutes. Now, here in blue, we're looking at the weekly change. And last week, energy was the biggest one at the end of the week on Friday. Energy was the one that had made the biggest change on the week in a change percent basis. Now, the way that my indicator works here, it didn't reset on Monday. So it's not like we can say, well, on the week so far, this is the change. That's not the way the indicator works. I wish it did. It'd be nicer. Probably something I should go in and code. But energy was dominant last week. And if you want to be able to do something like that, the TD Ameritrade website itself, let's not use this browser for that. If you were to go to the TD Ameritrade website, it has an entire tab that you can use to evaluate the sectors. And they've got a sector evaluation tool too. So they really have a lot of these, and it's not just TD Ameritrade, right? Schwab, Fidelity, IBKR, they all have these different tools that they provide on their website. Because they're all in competition to get you, right? They all want you as a client. They want your business. And so they're constantly focused on, well, what can I do? What can I offer you to get you to come over that maybe another place doesn't have? So on the TD Ameritrade website, if you go to research and ideas, scroll down, you got sectors and indices. So you can select your sector. You can select the time frame. Right now, it's set for 1 day. You bump that out to a week, to a month, whatever you want. And then it's got this. This is a tool. So if I was to hit that link, this pop-up box would show up, and you can really deep dive down into sectors and into industry and sub-industry and get a really great idea of what's going on out there, right? Follow the money. So this morning, 8:30, 10, 10:30, and 2. That's it, right? That's what we got on the day. So watch the clock there. Keep your eye on what's going on or when we're dealing with the market today. The expectation yesterday was that we had set our range, and I had mentioned it in the chat. We had our high and we very likely had our low. Well, obviously, we don't have our low yet, right? And when someone asked about the low, I had said, well, there's two lows that we could focus on. There's the most likely low, which would have been yesterday's low, and then there was the low before that. Still, that's our range. Until we get the FOMC meeting minutes, the market could easily maintain this range and it would not be considered bearish or bullish or anything else. We're on pause, right? We're on wait. So the market keeping this distance all the way down to 4250 is in no way bearish. And we can see the volume this morning is exceeding what all of the volume was yesterday, all the way up to 9:30, and it's only 7:50. So we definitely have some market participants this morning. We've already passed the 23.6 pullback, right? The retrace level. We're back inside the previous week's high. We're below the daily pivot. We're one ADR or half the ADR. And right now we want to focus on what the full ADR is, which is 42.44. We've got a 1.5% 21-day ADR, and we've already made the first half of it. So, we're getting kind of towards the extreme side of the level. There's still no market maker move showing up, so they're not pricing in any additional volatility yet. And we don't have a TRB line breakover yet. But we did cross back down through the 4-period daily moving average, right? When we're above the 4, we're bullish. When we're below the 4, we're bearish. This is a temporary bearish signal, right? Want to read that exactly how you would read the MACD. When you're dealing with the MACD, if you're above the 0 line, then you're in a primary uptrend. And if you get crossovers while you're in that primary uptrend, then you're in a primary uptrend with a secondary short signal. When you cross the 4-period daily moving average, you want to consider it the same way. You might still be in a primary uptrend, but you're now in a primary uptrend with a secondary short signal. So the expectation is right now that we will hold this range, the range being the low of Monday, and the high being the high of yesterday, until we get the minutes. And then from that, well, it's anybody's guess. If the market is convinced that the Fed is not going to hit us with the 75 basis points, if that's the leading thesis, then we're likely to come back up and retest that 43.27 zone. If the market does believe they're going to hit us with 75 basis points, then we're going to break that low of Monday, and we're probably going to go back to where we were before the CPI report. We do have that weekly pivot at 42.25, which is below the full ADR. Now, remember, the ADR is not the extreme argument, it's the average argument. So we could easily go to 42.44, and it would not be considered bearish at all. You wouldn't want to run out and start shorting the market. You wouldn't want to run out and start putting on a lot of swing trades to the downside. None of that would be a really good idea. Now, you could certainly take some day trades, right? Or even some very short duration swings, like between now and Friday kind of stuff. But don't go out there and bear up just because we happen to get down to 42.44 or 42.25, because those are not bearish levels. This is OPEX week, by the way, and there is a lot of options that are going to expire at the end of the week that are a part of the volatility metrics in the GEX and the DEX levels. So if that's our base argument, the bullish argument would be that we can hit the ADR to the upside. A full ADR is 43.74, and a half ADR is 43.41. If we were to actually start getting bearish, normally the argument for a range is yesterday's range. So let's keep that argument for a moment. Instead of focusing on the range of the last 2 days, we'll just do what we would normally do and focus on the range of yesterday. Okay, well, if we do that, if we focus on yesterday's range, then we are now inside day breakout. And the target after an inside day breakout would be the ADR, which we got that. Then it would be the pivot points of the previous day. So the cash open, the Globex high, the Globex open, the Globex low, and the RTH low of the day of the previous day. All right. So we would want to go in and mark those levels out. The cash open from that day is already marked, but we would want to hit the RTH low, the Globex low, the Globex open, and have all those lined up ready to go. Right. That way, when we move down through those levels, we've got them. Speaking of levels, let's look at the 5-day, 5-minute volume profile for a minute and see if there was anything down here, which, I mean, there was, but we've hit it by now. There was an untouched point of control right there. And you can see that that's where the market actually stopped. It paused. Sure, it wasn't to the tick, but people who randomly trade pivots instead of trading pivots constantly, like I do, they make this unrealistic assumption that price is going to stop right on a line for some reason. Just because you drew a line there, you think price is going to stop there, which it doesn't. But it did pause and consolidated that untouched point of control, which now it's been touched. We don't need it anymore. Right? So that level's gone. The value area low, which I've always argued I don't carry forward. It's just not my thing. The value area low lines up with the low of that day, and that I would carry forward, right? Because that kind of lines up into the way that I approach trading. But there still is other points of controls that can be marked out. So there's 42.52. Again, I don't generally mark that low or mark a value area like that. I would just get the low of the day. And there was a nice level of volume profile there at 42.70, which is, where we're kind of flirting around right now. And if we step back to the 10-day, we can see that the volume kind of shallows out, right? And in a shallow volume, we can move through those areas relatively quickly. So we've got, a little bit of volume there, not a whole lot. I wouldn't try to lean on it. And then past that, it shallows in again. And we don't start to see any significant help until around 42.34. So that's the value area high on the 10-day. When we're outside of the box, we anticipate the price is going to move back inside the box, right? Which is what we're working on right now. One of the benchmarks of yesterday was the VIX getting below 20, which it did not get below 20, right? But it sure did give it a nice try. We were watching that VIX at the 20 as we were watching the ES run into that 200 period moving average. And before we got there, there was this pause where the market seemed like maybe it wasn't going to make it up to that 200. And the expectation was if we can come down and get to that 20 and maybe break through it, then we could see the ES break up to that 200 period moving average. Well, we made it to the 20, but we never really made it through it at that bounce. And yet the market was able to power through just because we were there. We were at that 20, even though we didn't expand below it. Now, contract change, we're sitting up at 23.75. See if there's anything else to talk about over here. Yeah, Bitcoin running around, not keeping any of it. And there hasn't really been a lot of correlation with Bitcoin in this move up. We were talking about this yesterday. There's no perfect answer to why Bitcoin is not really participating in the rally up, unless you think about why the rally up is even happening at all. Performance chasing by fund managers that are left behind, short squeezes in really beaten down names like pot stocks and the Reddit short squeeze groups. So we got short squeeze going on, performance chasing. None of that really ties in with a quote risk on sentiment, right? It's like fund manager FOMO. So you're not going to see that correlated market state because if you look at Bitcoin as a pure risk on sentiment, This rally we had in equities was not everybody getting all bullish because they're seeing a bright, rosy economic future, right? It was based on FOMO and fund managers and squeeze triggers. So it makes perfect sense that Bitcoin didn't follow up with it, right? Instead, we've been getting these spikes and um, massive liquidation breaks. Gold too continues to set new lows. We're inside day breakout to the downside again in gold. Really big sweeping moves in the dollar and the bonds that are not being reflected in our market. And there's no really good answer for this on why and what we're going to do with it. The main thing that we can do right now is just to point it out and say, okay, these really big moves are happening. It's not affecting our market. Maybe we need to reduce our position size and approach with a little more caution. All right, so we're looking at the XLK, and these are the names within the XLK on the daily chart. The XLK is one of the three risk on sectors. So if the FOMC minutes are good today, we're going to expect to see the market continue this advance to the upside. And want to kind of try to narrow down, okay, well, where should I be focusing my attention? Right? Well, if we turn risk on again, then we're going to be focused on these names. Now, Nvidia had that significant gap down on like the 7th, and we've got the gap closed. Now we just got to get through that high. So that's one place I'd be looking. It's not really going to be a morning thing today, right? Across the board for this morning, I would not be expecting most of the equity markets to give us any kind of love other than perhaps a rebound off of these lows, just getting us back inside of yesterday's range, right? And that's not really advancing, that's just holding the line from yesterday. But think about the afternoon. Visa is primed for a range breakout, right? A really nice range breakout. So is Nvidia. Both of those have been on the books now for a while, right? When you think about like new 52-week highs or new 14-day highs, where we set a high and we come back and we start building a base and winding up a lot of energy, we come up and retest and break out. So Visa is primed for a really good move, and Nvidia, that'll be a really nice breakout level. If we happen to break out above that, at the very least, putting on a credit spread as we break out so that your break even is really close to that level and you get in with like a 1-1 on your credit spread. Not one of those risk four to make ones. I wouldn't recommend that for this move, but more of risk one to make one, meaning you build your credit spread at the money. MasterCard is another one where we had set a high, pulled back, been working through it. It had a really hard gap down yesterday, but managed to come back and take most of it. We're still looking for that completion, that follow through. PayPal, another one, set the high, pulled back, built the base. We tried to break out yesterday, didn't keep it, but we're still there. We're still primed, holding out. We were holding above the previous day's close on what we're going to get this morning, right? So when it comes to tech, we've got a lot of these levels prepped up and ready to go. Hey, it's Chewy. How you doing? Now, Adobe's been a pretty straight run, and Intel is quite a ways away from that pivot point. So not the same play in either one of those two. Same thing with Apple. It's been running. Microsoft been running. So different kind of chart formation, right? Intel, Adobe, Microsoft, Apple, I would set them in one group. And then Visa, Nvidia, MasterCard, PayPal, I would put into the other group. 4 and 4. All right. Finance has been doing really good, but we've got a lot of these that are kind of basing. Uh, that breakout in Bank of America, JP Morgan was not really so impressive in Wells Fargo, I guess is a good way to say it. Bank of America and JP Morgan was like textbook, beautiful, perfect. In Wells Fargo, it had gapped down enough that by the time it reclaimed that level and then managed to break out of the 812 level, there wasn't much left to it. So, it did make the same move. It just started lower down, right? But now we've got a level set, and Wells Fargo is closer to the round number, the 46. It's closest to the pivot point. We're very likely going to open below this morning, right? Just because of the sell off earlier. But um, I think that one has the friendlier opportunity. The You could use a smaller stop, and you know, cost wise, it's definitely cheaper than JP Morgan. Even their options too are a little bit better. Morgan Stanley's under the pivot, Goldman Sachs is under the pivot, and Citi is under the pivot. Citi's got the most work to do to get that breakout. So while it's worth keeping an eye on Citi, I really think that by the time it gets that breakout, there's not going to be much left on the other side of it. All right, stocks versus bonds. When this indicator is going up, stocks are doing better than bonds. When it's going down, bonds are doing better than stocks. We did get a crossover in the moving averages, but uh, the ratio pair got back above the moving averages. Stocks are still doing better. We are starting to level out a little bit. I would definitely keep my eye on that, especially since we're coming into a previous level. Momentum versus value. When the indicator is pointing down, value is doing better. And that's what we've been seeing since the early part of July. No change in that yet, although it is starting to flatten out a little bit. Large caps versus small caps. When the indicator is pointing down, small caps are doing better. That's what we've been seeing since late June, early July. And while we did tick up just a little bit, I wouldn't say that there's any real significant change there yet, right? Technology versus energy. When the indicator is pointing up, technology is doing better than energy. And that makes perfect sense, right? Because technology's a risk on, and we've been risk on since like mid July or mid June. Tom Bowley actually called that June 13 or whatever it was. He called that low. Um, give credit where credit's due. He nailed it. But either way, tech is still doing better than energy. It's a little weak, it's struggling. Makes sense. It's what we're seeing right between yesterday and today. But still no real significant change in tech versus energy. Growth versus value. When it's pointed up, growth is doing better. It's pointing up. Slight pullback, slight change in the last few days, but still no real significant change there. Emerging versus developed markets. Um, think of emerging markets as more speculative money. So when this is pointing up, we're in a risk on sentiment. And when it's pointing down, we're in a risk off sentiment. That doesn't really fit with what we've been seeing in the last few days, right? This massive expansion across the board where developed markets are actually better than the emerging markets. Now, since the 25th of July, we have started to tick up again. That emerging market, that risk on sentiment is starting to shine just a little bit, but I would say we don't have enough yet, right? That this is more of a base and a signal of a changing market structure, not a signal of bullishness yet. So we're not really getting that. Domestic versus international makes perfect sense, right? We want to gauge what's going on out there. FOMC here in the US is only one side of that central banker coin, right? There's central bankers all around the world. All the different nations out there are fighting the same inflation. They're just approaching it differently. Some places, like China, are still cutting rates while we're raising rates, right? So we gauge, the US versus international markets. Since domestic is the first name on the list, when the indicator is pointing up, US markets are doing better than international markets. And the big one, the one that is the most important out of all of these different correlations and ratios that we're looking at, discretionary versus staples. Offense versus defense. I've heard this said a lot of different ways. When this is pointing up, then we are in a risk on sentiment. And when it's pointing down, we're in a risk off sentiment. We've been basically pointing up since that little micro head and shoulders on that thing, uh, late June, all the way through July into August, and just a very slight pullback. And that is based on, before the end of the year from 2021 into 2022 and continuing all the way through 2022 and now back up the other side of it. This thing called the turn before the turn happened, right? Before the crossover of the 1020 on the weekly chart. It called the top. I like that divergence. Yeah, you like it. Yeah. All right, we're looking at the number of names in the Nasdaq making new 1-month highs. And this chart goes all the way back to 2012. So imagine everything that we've seen since 2012. The Brexit, Trump, COVID. And look at how many names are making new highs in the Nasdaq. Now, this is the full Nasdaq, the Nasdaq Composite, not the Nasdaq 100, which is why you're able to see names like 1,200 names making new 1-month highs. Names hitting new 1-week highs, 3-month highs. We're getting into some pretty extreme levels. You have to take a step back and realize that at some point, going higher becomes the riskier proposition, right? You know what they always say: markets don't fear a crash up, we fear a crash down, right? Well, at some point you get too overextended and the entire market starts to think, well, I don't want to buy this high. And then we set a new high and it's, well, I don't want to buy this high. And then we get another high, right? The market starts to price in a move down, which means if we do liquidate to the upside, what they call a topside breakout, right? Or a blow off top, that we're yet again going to squeeze all those shorts and get another break even higher. So at some point, the market actually does begin to fear a topside expansion. Right now, this is the next level that we want to focus on. We got to the 200-day moving average, and like gravity, it just pulled us up to it, and that was as far as we got, right? That was the end of the line. The market flipped it over and dumped it back down from there. The next one is that line, right? It's it's plain, it's obvious. I mean, it's right there. You can't miss it. And that means everybody is looking at it. Now, again, just like when I bailed out yesterday before we actually got right to the 200, you got to start to ask how many people are going to front run that red line? How many people are going to start to short before we get there? And I know it may seem like that line is really close, but if I zoom in, significantly here, it's quite a distance away. It's a good 20 points. But how many are going to front run that thing and start to short before we actually hit it? It didn't happen in the 200. We went right through that 200 yesterday and then dumped off the other side of it. We could very easily do the same thing in that red line or just straight up break right through it, be on the other side of it. The NASDAQ, on the other hand, still has plenty of room to run, right? At least with those moving averages. We had our breakover already. So 14,035 is the NASDAQ target on the NDX, not the NQ. The Russell's already made it through there, but that makes sense because small caps has really been a large part of this move. The most beaten down names have been a part of the run back up. Here's the list of the top high short interest names. Backslash SH There's your short rate, short vol, top short vol, short sales, and you want top high short interest stocks over 20% ratio. And then it's going to give you an option of what percentage do you want. Let's get rowdy with it. Put in something crazy. Nothing. Maybe I went too far, huh? Right, 30. Nope. We'll just leave it at 20. BBBY leads the list, right? So I believe I seen another name. Let's see. I know there was another one that really got my attention. Big Lots is on there. That was the other one that got my attention. MSTR, Upstart, Beyond Meat, Fubu, Wayfair. So there's some well-known, really good names that are on that high short interest list, right? And it's just a massive squeeze going on. You can also check the Wall Street Bets list and see what they're focused on. Let's see what the I don't remember the code for it. Let's see. Aha, Discovery. This is what's being talked about on Wall Street Bets this morning, right? So, um, obviously, Target right ahead earnings, Tilray, Walmart, Apple, AMC, Tesla, Fobu, GME, Spy. Obviously, everybody talks about Spy always, right? So I wouldn't get too hung up this morning. I would be spending a lot of my effort focused on what the afternoon is going to give us for an opportunity. So what I got for you guys, be careful, be safe. I'll see y'all tomorrow.